welcome everyone. My name is Halima Siddiqui. I'm the executive coordinator here at Health Nexus. Today's virtual training is regarding financial planning across the lifespan for your loved one with FASD. Before we begin, I would like to just start off with a land acknowledgement. We would like to begin by acknowledging the Indigenous people of all the lands that we are on today. While we meet today on a virtual platform, let's take a moment to acknowledge the importance of the lands which we each call home. We do this to reaffirm our commitment and responsibility in improving relationships between nations and to improving our own understanding of local Indigenous people and their cultures. From coast to coast, we acknowledge the ancestral and unceded territory of all the Inuit, Métis, and First Nations people that call this land home. Please join me in a moment of reflection to acknowledge the harms and mistakes of the past and to consider how we can each, in our own way, try to move forward in a spirit of reconciliation and collaboration. A couple of just house rules before we move on. Kindly stay on mute and off camera during the presentation. If you have any questions, please ask them in the chat. We will answer questions at the end of the presentation, and remember to please not use any identifiable information when asking your questions. And after questions have been answered, we can take a few minutes to network and chat about group updates. If anybody has any, please put them in the chat and we can discuss them at the end of the presentation. So I'd like to introduce our speaker today. Tanya is a certified financial planner and senior financial consultant with IG Wealth Management in Ottawa since 2012. She's passionate about guiding families and business owners through complex and unique financial situations. As a trusted advisor for families navigating the intricacies of special needs planning, Tanya uses a comprehensive 360-degree approach. This considers the whole family's goals alongside providing lifetime support to a loved one living with a disability. With a keen focus on preparing for the unexpected, Tanya aims to bridge the challenges faced by these families with solutions and sound advice that paves the way for long-term security and peace of mind. And with that, Tanya, I will pass it on to you.
Thank you so much, Halima, and good afternoon, everyone. Welcome, parents and service providers, and thank you to Nexus Health for hosting this session. So for families impacted by fetal alcohol spectrum disorder, financial planning is essential for ensuring the long-term care support and quality of life for loved ones. And so today's 20-minute webinar serves as an overview of the essential considerations. The goal will be to provide a foundational understanding and to highlight their significance in the financial planning journey. And so what is financial planning? That's a great place to start. Financial planning is the process of setting goals, managing resources, making informed decisions to achieve financial security and well-being. That's what it is in a nutshell. With respect to special needs planning, the provinces and territories will have different rules and regulations. So for the purpose of this webinar, I'll be speaking from the lens of Ontario. And a disclaimer, this is not intended to solicit any products or services. This is purely informational. Let's begin by shedding light on the landscape for individuals with a disability. Continue pressing next until the entire screen displays. Thank you so much. Keep going. It's noteworthy that a significant portion of the population are diagnosed with a disability, with many facing challenges in accessing employment opportunities and financial independence. And despite representing 22% of Canadians over the age of 15, a portion of this population has limited or no income, relying on a combination of family support and government funding for their financial well-being. And despite the availability of financial tools like the Registered Disability Savings Plan, only a small fraction of eligible individuals have even opened one. And so this low uptake might highlight the need to raise awareness about financial assistance programs and encourage families to explore these resources for long-term financial security. Next until the entire screen displays. If you are directly impacted by FASD, these are questions you may ask yourself. And in addressing these common concerns, which we'll do today, we can better equip individuals and families with the knowledge and resources to effectively address them. Next. We'll learn today about the disability tax credit and the Registered Disability Savings Plan, in particular, and how to use these to your advantage. And then we'll look at ensuring your loved ones are cared for with key legal documents to have in place, protecting loved ones through insurance and preserving social assistance benefits through a discretionary trust. Next. The starting point in saving for the future begins at diagnosis. Upon diagnosis, the first step is to have a caregiver or a parent apply for the federal disability tax credit, regardless of age. This unlocks eligibility for the registered disability savings plan, which is often a primary savings vehicle for a person diagnosed with a disability. Additional programs for an individual that they may qualify for are tax-related benefits like tax credits and deductions. These free up money that can go into other planning areas. And then there's government funding. There are programs available for children, such as the Special Services at Home program. And then there's programs for adults, such as the Passport program. And for a lot of parents and caregivers, advocacy groups, whether charities or nonprofit organizations, particularly those focused on FASD, are an excellent resource to orient them on the programs and benefits they're entitled to, which will save them an enormous amount of time and money probably in the long run. Let's dive into the disability tax credit next. This tax credit is a non-refundable tax credit that helps people with a disability reduce the amount of income tax they have to pay. This is different from a tax deduction. Now, if an eligible individual does not pay enough income tax to apply the tax credit fully, unused amounts can be transferred to their spouse or to a supportive family member who provides them with the basic necessities of living. And by reducing the amount paid, those dollars can be allocated elsewhere. The value of the tax credit, all told, is, and I'll just round down, is $1,400. If it's a child, it's $2,200. That means up to $2,200 can go towards other needs. It can be the RDSP or RESP contribution. It can pay the annual life insurance premium or the annual museum membership, or perhaps it's to offset some of the extra costs related to FASD. Being approved for the disability tax credit can also qualify an individual for other tax benefits. For example, the child disability benefit, which is a supplement to the Canada Child Benefit. And then there is the disability supplement to the Canada Workers Benefit. A great tax advisor who understands one's personal situation can really do a good job to figure out how to maximize and optimize all the deductions and credits that are available. Next, regarding eligibility, that does next until it all shows up. That does depend on having a severe and prolonged impairment in mental or physical function. And over the last 2 years, the eligibility requirement for the disability tax credit and the application itself has been enhanced to make it easier for individuals who should be eligible apply. For anyone that's ever gone through the application process, it's not for the faint of heart. More activities are now recognized in determining time spent on life-sustaining therapy. The list of mental functions necessary for everyday life has been expanded, and now the application itself can be completed online versus one CRA My account. So if you know of someone who may be eligible and has not previously applied, please do share these updates with them. Next, let's jump into the RDSP. The Registered Disability Savings Program helps individuals diagnosed with a disability and their families save for the future. An individual who is eligible for the disability tax credit would be the beneficiary, and there's no minimum age to open it. There is government matching and extra funding for low-income beneficiaries, and that form part of the plan, which continues to grow tax deferred until there is a withdrawal. Now, there's two roles in an RDSP. There's the beneficiary, who will benefit exclusively from the savings, and then you have the holder, who is the person that opens the account, makes the contributions, and authorizes friends and family members to contribute. That person can be a parent, a legal guardian, or a qualified family member. And the beneficiary themselves can be the holder, provided they are age of majority and are legally competent to sign a contract. Now, it is a long-term savings tool, and it is designed to pay lifetime income beginning at age 60, although withdrawals may occur sooner, subject to repayment rules. Because of these two elements, the RDSP may not be viewed as a viable option for some circumstances. In fact, there is still value to holding an RDSP. Let's look at it a little bit closer. Next. A maximum of $200,000 can be contributed to a beneficiary's RDSP until they reach age 59. Grants are awarded as matches, while bonds don't require a contribution at all. They are automatically deposited if certain income levels are met. Grants are awarded up to $3,500 each year, again, depending on family income, and bond deposits are up to $1,000 annually. You can see in the chart the lifetime limits and the annual limits. And that is potentially $90,000 in government assistance to help boost the personal savings. And even if no personal contributions can be made, the account can still be opened to receive bonds. Now, that lifetime limit of $200,000 is enormous, and truthfully, most people don't actually maximize it as part of their regular personal savings program. But what this limit does provide is room to receive inheritances without affecting social assistance benefit rules. There are various ways an RDSP may be funded with an inheritance that are lesser known. One example is tax-deferred transfers on death from an RRSP, a RIF, or a registered pension plan. They are permitted to an RDSP provided the beneficiary was financially dependent on the account holder, who would have to be a parent or grandparent. The merits of whether one should or shouldn't do that is situation specific and is beyond the scope of what we'll discuss today, but that is shared just as an example of how it can fund into an RDSP. And the value of an RDSP can grow to be substantial. Let's say we have a youngster 5 years old who qualifies at the highest grant level. If the holder could set aside $1,500 for the next 20 years to invest into the RDSP, and let's assume a 4% rate of return, which is quite reasonable, the plan could grow to $180,000 by age 25. Next, a note on family income. Before age 19, it's based on the parents or the caregivers and their spouse. After age 19, it uses the beneficiary's net income and their spouse. Where they reside, whether it's the family home or other, is irrelevant. So it's really important for the person on whom the income is based to file their taxes annually, even in years of zero income. Next. Withdrawals. Next. Withdrawals may happen anytime, although lifetime withdrawals may begin in the year the beneficiary turns 60. The payments can be used to supplement income, cover disability-related expenses, or enhance their quality of life. Now, there are minimum and maximum withdrawal limits that vary depending on various factors. Generally, if government contributions are more than private contributions, the maximum planned withdrawal is 10% of the assets in a given year. Next. If a withdrawal occurs before age 60, it is subject to a repayment rule known as the 10-year rule. A withdrawal before age 60 will cause a clawback or a repayment, if you will, of the lesser of two amounts, either all of the grants and bonds that were paid into the account in the last 10 years, or 3 times what the withdrawal is. So recall that example about the 5-year-old with the RDSP growing to $180,000 by age 25. If at 25, the holder decides to withdraw money to buy the beneficiary a car, well, it's mostly grants, so they'll be limited to an $18,000 withdrawal. Therefore, the amount repayable would be 3 times that amount, or all the grants and bonds received. So $54,000 versus $45,000 would get paid back. Now, withdrawal at age 60, really, it doesn't suit all circumstances, and there may be a need to withdraw earlier. A holder could set out to maximize the grants early on in the plan's lifetime, and then decide to revoke consent to receive any further grants or receive any further bonds, and then allow 10 years to pass. This would then render the grants and bonds that were payable in the last 10 years as zero. That means the payment from the withdrawal, would be nil. Now that takes a bit of forward thinking and planning. And for that reason, an RDSP is not suitable to fulfill any short-term cash flow needs. Now remember, the payment from an RDSP does not affect ODSP benefits whatsoever. And then different rules do apply in cases of medically certified diminished life expectancy. The holder may elect to choose between alternate withdrawal limits. Now let's talk about next the transition to adulthood at age 18. This marks a point where services and supports directed to children end, and eligibility for the Ontario Disability Supports Program begins. ODSP helps individuals with living expenses, employment supports, and health benefits, and they must qualify on a health-related basis and also be in financial need. And in general, a person will not be considered in need unless certain asset and income criteria are met. Some assets are exempt from this criteria. There's quite a long list, but some of the more popular or well-known are a principal residence, a car is exempt, an RDSP and RESP for education savings are also exempt. Income received from any source will reduce ODSP dollar for dollar unless it too is considered exempt. Examples of exempt income would be withdrawals from an RDSP and $10,000 received from a trust over 12 months if not used for a disability-related good or service. And this is an overarching theme that is something that I think a lot of parents, service providers, and self-advocates have heard for themselves, is to protect eligibility. All assets and income should be structured to be exempt. And transitioning to adulthood may also include changes around housing arrangements. Different housing options offer varying levels of support, and the more independent or individualized, the greater the cost. As families evaluate the resources available for housing, it's essential to consider the long-term financial sustainability of the arrangement, and establishing clear priorities can guide them in decision-making and how to resource allocate during times of financial constraint. Next, let's slide into ensuring your loved one is cared for. We discussed the importance of saving for the future, and it's also important to ensure they're cared for now in the long term. Let's look at the key aspects in arranging one's affairs to safeguard their financial well-being. Next, there are 3 legal documents a parent should have in place: a will, a power of attorney, and a healthcare directive. A will allows you to outline how you want your assets to be distributed after your passing, including provisions for your loved one's care and financial needs. The person you appoint as your executor has the responsibility of paying your debts, filing your taxes, and making sure your assets are distributed. It's important to select someone who's capable of handling the job, trustworthy, and generally you'd want someone that lives in the same region. And if guardianship will be part of your wishes, be it physical or financial, this will also need to be a designation. In the absence of a will, someone may have to apply to be the personal representative, or someone will have to apply to be the personal representative, and the court could apply and appoint someone that is not of your choosing and wouldn't be the person that you would have chosen. And then your estate would then be distributed per the intestate laws of the province. If there is a minor child with FASD, your personal representative may be required to transfer their inheritance to the government for control until the child reaches age of majority, in which case they receive the inheritance in full. Power of attorney for property, that's someone you appoint during your lifetime to look after your finances if you lose the capacity to do so. A healthcare directive, that's also someone you appoint during your lifetime to make decisions about your healthcare if you're not able to. It means you can lay out your preferences for medical interventions and your future care. The more you know about your wishes and the more you can share that with your attorney, the better position they are to carry that out. Next, when we're looking at leaving an amount of money to an individual with FASD, there are a few possible strategies. Next, you could look at left to a third party, perhaps with the unstated expectation that he or she will do the right thing, that may not be enforceable, and legally the assets would belong to the other person. If your loved one is an adult when you pass away and you don't specify otherwise in your will, they will also receive their full inheritance directly, which may impact social assistance benefits if they are beyond the asset limits. Lastly, introducing a Henson trust can be a valuable strategy. This type of trust allows you to leave assets for your loved one's benefit without affecting ODSP eligibility. This is a type of trust called an absolute discretionary trust, where the trustee manages the assets for the benefit of the beneficiary. The trustee has complete discretion to determine when, if, how, and how much can be distributed to the beneficiary at any given time. And because the assets belong to the trust and not the beneficiary, that's why it's considered an exempt asset for ODSP. And so who should be the trustee of a Henson trust? Well, this is established in your will, and it doesn't necessarily have to be the same person that you've named as the executor, but it can be. Either way, the trust is designed to last for the lifetime of the primary beneficiary. So the person selected should be a capable adult who is willing and wants to act and are also trustworthy, and ideally have a relationship with the beneficiary or are willing to develop that relationship. Ideally, they should reside in the same region. And if you don't know of anyone who may be able to act in this capacity, consider appointing a corporate trustee or a trust company. Now, a Henson trust may not be necessary or appropriate if an inheritance will be more than what a beneficiary would receive over their lifetime from social assistance benefits, although there may be other reasons for including it. There are several ways to think toward the future of your loved one and what they'll need and how to best set up plans. Next. Now, what about the caregiver? The two most valuable assets are the care they provide to their loved ones and their ability to earn an income if they're working. And while your loved one depends on you for love and support day in and day out, they also rely on the continued earnings to provide for their regular living needs. An injury or a long-term illness could severely affect one's ability to care for others if they're in a caregiving position. And so there's various insurance options that fulfill different purposes that a family should be considering. There's life insurance that provides benefits after death. In this scenario, specifically thinking of special needs planning, life insurance is commonly used to fund a Henson trust if there's not going to be sufficient assets on death. Disability insurance helps pay expenses while you aren't working and protects savings. It's a regular stream of income to meet ordinary expenses. And then you have critical illness insurance. This enhances basic medical coverage by providing an amount to use while one is still alive as they see fit. That can be used to pay the mortgage, unexpected expenses, or to help support a loved one while you recuperate. And long-term care insurance alleviates a big fear for a lot of people, which is burdening others in the event of a lengthy illness. Next. Reflecting on today's topics, there are risks associated with delaying to or failing to financially plan for individuals with FASD. These include unintended consequences, missed financial opportunities, and reactive responses to financial challenges. I'd like to summarize the key takeaways on this second half, which was ensuring your loved ones are cared for. Number one, ensure there is adequate life and disability insurance coverage, not only to protect yourself and your savings, but as a vehicle, if needed, to fund the Henson Trust. Two, select executors and trustees carefully, and in situations where there is no suitable individual to act, consider appointing that corporate trustee that I had mentioned. They do offer expertise and continuity of service, and they can ensure the trust is managed effectively and in the best interests of the beneficiary. Another arrangement could be a co-trustee alongside, which might be a suitable family member. That's also an option. And then you have an arrangement that combines both the professional expertise with a personal understanding, and then you have that effective trust management while still maintaining family involvement and values. That does come at a cost, trustee services, which may or may not be a new topic to people. And it's important to quantify whether the cost associated is suitable for the size of the trust. Number three, avoid using direct beneficiary designations of an individual with FASD for whom you wish to protect their social assistance benefits. Do not name them as a direct beneficiary on insurance policies, any investment accounts, and avoid adding them as a joint owner on any assets or any property. Number four, explore creating a trust to hold the inheritance. In many cases, a discretionary trust may be suitable, most suitable. And the Henson Trust cannot be created after death. It has to be created while you're alive or in your will. Number five, update your POA and your healthcare directive regularly, every 2-3 years, or when there is a material change in your circumstances to ensure it's still relevant. Next. Now, as service providers, your role in supporting individuals, caregivers, and families is invaluable, and you play a vital role in helping them navigate the challenges they faced. And I hope the insights shared have provided an enhanced understanding, perhaps, of the disability tax credit, the RDSP, and some estate planning considerations. And armed with this knowledge, hopefully you can help expand the understanding across families and help them support them better in their financial planning journey. I'd like to extend my appreciation to each of you for joining more to learn more about this important area. And we've only scratched the surface, and I hope some of these areas have inspired you perhaps to delve into more of some of the topics that we've discussed here today. I'm welcome to answer any questions that folks may have, if anyone has any.
Okay, so first question. I have heard from some caregivers that they cannot find anyone to take on the role of executor and/or trustee for their loved one. What can families do in this case?
Yeah, that's a common concern indeed. A corporate trustee or a trust company could be one avenue to investigate. A corporate trustee is a professional trustee or an executor. So they do, different trust companies or professional trustees have different services. Some of them offer the role of being a trustee for a Henson Trust or any type of trust. They also provide executor services. So that would be one avenue for families to have a look at in the absence of having a family member that can step in. And they do come at a cost, which I touched on, and you sort of have to weigh the benefit of that versus the value of what they're managing.
Another question we have here is, what professionals would you advise assist? Lawyer, accountant?
Great question. All of the above. So a accountant is great when you are filing your taxes to make sure that you're optimizing the credits and the deductions available to you. So that should be part of your team. A lawyer is necessary in order to draft the legal documents, and they should be somebody that you can also integrate in your team and meet with on some level of frequency, be it, every few years or when there's a material change. And then having a financial advisor or your financial planner who you also interface on a regular basis. Together, these three folks start to build out an understanding of your financial or one's financial circumstances. And then together, they're the ones that can help identify those opportunities and then mitigate the risks for you. And that's really the value in having them work together, or at least engaging them at different times. But you definitely want all three of those people in your back pocket.
When working with First Nation communities, are the same eligibilities available as income tax is not assessed the same?
That's a great question. And truthfully, I don't know the answer to that, to be honest, with respect to how that is treated. I'm happy to, I can certainly collect some information and pass that along if that's something would be useful to you.
That'd be great. You can send
Yeah.
it over to me and then I can share it
Okay.
with, yeah, thank you so much. Next question, how to ensure the three are communicating and engaging and related costs?
So I would say for the professionals, so I would use your financial advisor or your financial planner as kind of the quarterback in that part of the relationship. So there tends to be a frequent interaction between clients and financial advisors. So you might find that they start to gain a broader understanding of one's situation kind of across different areas. And they will, if you certainly highlight, look at, I like you to actually engage with my lawyer. I'm not clear on a few things, or I want you to meet them so we can kind of coordinate plans. They will 100% step in and reach out to the lawyer so that it becomes more of a synchronized plan and a synchronized approach.
Next question. Do you have any information on the federal disability benefit that will hopefully come into effect soon? Will recipients be able to get this in addition to ODSP? Do you have an idea how much it will be?
I don't have information on that specifically. That is something along with the First Nations information that I'm absolutely happy to send along.
That'd be great. Yeah.
Yeah, no problem.
Next question. Even though FASD is a permanent disability, some people are asked to reapply for the disability tax credit every 5 or 10 years, and some are turned down when they reapply. What happens to an RDSP if a holder of it loses the disability tax credit? Do they have to pay back the grants and bonds to the government?
That's a good question. So the rules recently changed with respect to the disability tax credit. Yes, it used to be that the plan had to be collapsed, and yes, the assistance holdback amount, so those grants and bonds paid in the last 10 years have to be paid back. That has recently changed where I believe the plan does not have to be collapsed. The grants and bonds still do have to be paid, but the plan can either stay intact, it can't attract any more grant room, but it can still remain in existence. And then there may be an opportunity to roll it into another account type, such as an RESP.
Do Henson trusts have a set amount that can be withdrawn each year?
No, it's at the discretion of the trustee. They can choose what the amount is, which is another reason it's important to select someone who understands or is willing to learn about the ODSP rules. So with respect to ODSP rules, there is a limit of $10,000 in gifts or voluntary payments from any source for non-disability related items. So in this example, a Henson Trust withdrawal may be limited to that $10,000 over a 12-month period if it's not used for disability related expenses. I would just like to add, if you don't mind, one more thing, Halima. I will share with Halima and Nexus Health some information on RDSPs and special needs planning that she can pass around after the fact. And if there might be some additional information there that I think folks may find valuable, and will highlight some of the things we discussed today.
Absolutely. Yeah, that would be great. And I can share that with everyone. Um, Yeah, other than that, thank you so much, Tanya, for this absolutely very educational presentation. I feel like we might have some questions after this as well, so I will send those to you. Um, yeah, thank you so much, everyone, and stay tuned for more virtual trainings and webinars by Health Nexus.
Thanks so much. Take care, everyone.